Welcome, everyone. Today, we're going to talk about how you should hold title to your home and why is it important to maybe set up a trust if that is applicable to you. And today, I have a special guest with me, Alan Khalfin. He is a local attorney here in the San Francisco Bay Area who actually specializes in this area of law, and he'll be sharing some great insights with us about this topic. So thank you, Alan, for joining us today.
Thanks, Mike, for having me.
Maybe just a quick little disclaimer before we get started here, so we don't get into any legal trouble. Everyone that's watching this, just wanted to make sure that this content's created basically for informational purposes. We're not establishing any agency with me or any representation with Alan. This is purely for informational purposes, general information. If you have any specifics, please reach out to one of us directly. We're happy to schedule a time with you for a consultation and get into the specifics of your particular situation and help you out. With that being said, let me introduce myself. My name is Mike Sinitsky with Rise Homes, and I am a local San Francisco Bay Area realtor. And today I'm joined by Alan Khalfin. He is a attorney specializing in real estate, specializing in probates, trust, and so on and so forth. Alan, if you could please introduce yourself and just tell us a little bit about yourself.
Thanks, Mike. My name is Alan Khalfin. As Mike mentioned, I am a trust and estates attorney, have been doing this for more than 15 years, have helped thousands of families set up estate plans, write trusts, deal with probate, deal with death of loved ones, and that type of thing. I'm from the San Francisco Bay Area. I was born here. I grew up here, and I love working with clients that are from here.
Being from San Francisco, there are certain ownership structures that are pretty common in San Francisco, but might not be common in other areas of California or other states. So we'll probably be touching on those. So it's great to have somebody that actually specializes in our local market. So let's talk about the topic today, which is how you should hold title in your home and trusts, why someone should set up a trust. Maybe before we dig into those reasons, you could maybe share some important information on why it's important to hold title to a property in a certain way, just as a generality, and what kind of problems could be caused if you potentially don't hold title the correct way.
Yeah, absolutely. So as an estate planner, what I see more often than not is that a person's primary asset, their nest egg, if you will, is their residence. Perhaps they have other real property, but most have their residence, and it being in the San Francisco Bay Area, it is worth considerably more than in other areas that we may practice in. So when you're in here in San Francisco, you really have to be mindful of how title is held. Now, what is title? Let's start there. When you purchase a home, it is often a very complicated and difficult process that somebody like Mike helps you through. And there's so much going on during that process. Your loan, and you're looking for the home, and just it's a little bit chaotic at times. And one of the things that once you're in escrow, one of the things that the title company will ask you is, "Hey, how do you want to take title?" And oftentimes people don't think too much about that. There's a lot of other decisions to be made. They just say, "Oh, here's my name." So what is title? Well, when you close escrow on a home, you get a piece of paper known as a grant deed. And that is the official ownership document or title to your house. Okay. It's usually 2 or 3 pages. It's short, it's sweet. Oftentimes in a massive stack of closing documents, you may overlook the 2 or 3 page grant deed, but that is the most important document. And so that is your title. And on that grant deed, there is one section called the grantee. The grantee is the buyer, or you, as you're acquiring the home. So however your name or names, if there are more than one person buying, however those names are listed in the grantee section of the grant deed or the title is what we're talking about. Mm-hmm. So, and it's insanely important how that's set up, right? There's all sorts of options. If you're single, if you're married, if you have a domestic partnership, there's all sorts of options. And it requires some thought. And unfortunately, what we see a little too often is that it's a bit of an afterthought.
Yep, absolutely. I see that time and time again. Unfortunately, people that buy homes with me, I recommend them to reach out to someone like yourself to set up a trust or to discuss, ownership before they close escrow. And they just put it off till a later time for whatever reason. Life gets in the way. They don't feel like it's super important. They're like, I'll just get through with this, close escrow, I'll own the home, and I'll get around to it. And then eventually I get a phone call like, oh, one of my employees got into an accident and I don't know if my insurance is going to cover this to the max. And what do I do? And I didn't set up the right protections. And it's unfortunately people do this after the fact. So I think the big takeaway from what you just mentioned here in the beginning is don't leave this till the last minute. Matter of fact, I would suggest to most people, if you're buying a home, you should have this conversation as part of your educational process of when you're buying a home. Something I do with my clients when they're starting their home buying journey is I take them through an example disclosure package. I teach them how to review inspections, all the seller documents and various docs that get disclosed during a sale that are pertinent to that particular area that they're buying in. But I also walk them through the purchase agreement, the offer document that they're going to be signing when they're going to be making their offer that's going to legally bind them to the purchase. And I think just as important is to take some time to educate themselves on how to properly hold title. More often than not, it's couples buying a home. And so it could be pre-marriage, post-marriage. Somebody might be contributing more money than the other and they want to do an uneven split. And there's various scenarios. And I think this is an important step before you even make an offer on a home to decide how you're going to hold title. I think that's crucial. Would you agree?
I would agree. And a bit of a spoiler alert, how you should hold title to your home or any other real property that you own anywhere in the United States is through a trust. That is a really easy and rather simple way of holding title, and it will avoid a lot of complexity and expense if you were to pass away. So that's the spoiler alert. There are different options for joint ownership, but at the end of the day, if you own real property, you should have a living trust to hold title.
Absolutely. Agreed 100%. Well, before we get into that part, maybe we can just talk about the different ways to hold title and the high level differences. And again, if anyone wants to learn more details about these various ways of ownership or holding title, you can always reach out to one of us for more detail. Of course, Alan's a specialist in this where he can actually get into the legal side of it. But can you share with us what are the different ways that someone can hold title?
So if you are an individual and buying property by yourself, then really you have two options. For this conversation, I'm not going to talk about some more advanced structures that people may use for asset protection goals or for high net worth estates. Really, the options that I'm going to give to you guys are really what most of us use. These are for those of us that are under the estate tax exemption of nearly $30 million for a married couple. So for most of us, there's a few options. If you're an individual, there's really two. You can either take title in your name, Joe Smith, an unmarried man, or you could take title in a living trust. The difference is quite simple. And I think using the individual example was actually a little easier to understand why we push trust so hard, because it's a little bit more binary. There really are two basic options here. Now, if Joe holds title in his name, one day Joe will pass away. And if at the time of his death, the title is in his name still, then that property will go through a court process, which we call probate. Probate is a terrible court process. It is one that can take at least 2 years. And it is one that will cost a percentage of the gross value of the property. So the market value.
Right.
Not factoring in the mortgage that may be on it, not factoring in any delinquent property tax or what have you. It is the fair market value. And the fees are based on that. And so it's, literally the first 4% of the first 100,000, 3% of the next 100,000, and it goes on and on. So, for a house that goes through probate, for $1 million condo, let's say, that goes through probate, you're looking at $30,000 in legal fees and costs to settle that estate. You're looking at a 2-year process, and you're looking at a public process where whatever drama or interesting facts about your life will be revealed in the public record.
Yep.
And so typically, as an estate planner, my advice is that your estate plan should be set up to avoid probate.
Absolutely.
That is really the general theme. You got to avoid probate, right? So instead of paying 25 to 30 grand to settle your affairs, it can be done for a fraction of that cost in a few months.
This is the part most people don't think about. And I think a reality that we have to discuss is this isn't just for old people. I've unfortunately seen young folks pass away as well and not do this planning. So a lot of people think that this is just for someone that's old or might have a family and kids. This doesn't matter whether you're single, you're married, whatever the case may be, you have a partner, whatever the case may be. This is something that you should be concerned with right away. Whether you're buying property today or you own property today, it doesn't matter. You should be considering this. And I say this because this is very near and dear to my heart, because one of the things we specialize here at Rise Homes is probate sales. And you're 100% right. It's a very public process. And there's a high probability that a realtor like myself will be calling you along with 5, 6, 7, 8, 9, 10 other realtors that are going to be courting you to get your business. There's going to be various different services reaching out to you. Your information will be public. There might be conflict within the family. What money always muddies the water. Countless times I've seen people get into probate and they think everything's fine. Yeah, my brother is going to be cool. My sister is going to be cool. Everything's going to be okay. And the moment money gets into the picture, things get weird and people start arguing. And it further prolongs this court process. And I want to clarify one other point. If you could answer a question for our viewers. Does it matter whether the person passed away with a will or without a will? And if in either of those situations you could avoid probate court?
Doesn't matter. If the person has a will, so in this case, the title was in their name. So Joe Smith died away. The title of the house was in his name. Joe had a will that said this house goes to Sally. Unfortunately, probate is not avoided because Joe has passed and now his will needs to be admitted into probate. There are essentially two different types of probate. One is where the person had a will, and the other is where the person had no will. If the person had a will, the will serves as essentially a set of instructions for the judge. And the will, to get distribution on the will, you have to go through the entire probate process. That's when distribution through a will occurs. Right. So, I mean, the house could be sold during probate before the distribution, but in any event, that's what a will is. Yeah. And if there's no will, that, it's same probate, just maybe a little bit harder, but it's separate degrees of awful, basically. You're in a terrible situation and it drags on. And so it's really the worst way to settle an estate, particularly when a family is grieving. It's just, the last thing you want to deal with is to go to court a handful of times and to just have this process on your head for several years.
100%. There's other ways that people commonly own property. Maybe we could cover those, and then we can kind of at the end talk about trust in detail and what can be held in a trust in addition to real estate, maybe, so that we can educate our viewers as well on that. But so we have the single person scenario. Let's say maybe it's a couple, maybe partners, maybe business partners. Can we touch on those ownerships and how the property can be owned in that case?
Yeah, so let's start with married couple, domestic couple, not business partners. So for joint ownership, there are a few options. The thing to be aware of is, there's a split, right? There's the individual title. So there's various options there, or you can put it in the trust. So if you don't have a trust and there's joint ownership, your options include joint tenancy, community property with right of survivorship if you're married, or tenancy in common. And they all function a little differently, and I'll walk you through them. But what they all result in after the death of every joint owner is they all result in probate. But they have differences, right? So if you are married and you don't have a trust and you absolutely need to close before you do a trust, then your best bet would be community property with right of survivorship.
Okay.
With that, if one spouse passes, there is a right of survivorship for the other spouse on the title. What that means is no probate is required after the first death, and the surviving spouse can record a document called an affidavit of death, which will put him or her on title as the sole owner, right? So probate can be avoided for the first death due to what we call a right of survivorship. So that's one option. The other option, if you are not married with your joint owner, but you want for there to be a right of survivorship, that option would be called joint tenancy. Kind of like community property with right of survivorship, except it's not for married couples and it loses some of the tax benefits that married couples get with community property with right of survivorship. But a joint tenancy also has that right of survivorship after first death, meaning the surviving joint tenant will acquire full title through the recording of, an affidavit of death without going to court. So there is that about joint tenancy and community property. The third option is called tenancy in common. And unlike the first two options that I mentioned, it does not have a right of survivorship between the owners. So this is the one that you would use for perhaps a business partnership or another situation where if one owner dies, you do not intend for that owner's interest to go to the other surviving owners. So that, again, is called a tenancy in common. And that is where on the title you'll see percentages of ownership and, 70% John, 30% Sally as tenants in common. That's what that means.
And that arrangement, tenancy in common, can be used for both, like, let's say you and I bought a place together. Let's say a two-story building in San Francisco, super common, right? In SF, we have TIC, and there's TIC agreements, tenancy in common agreements, oftentimes between two owners. And sometimes we sell in San Francisco TIC units. They're not condos. The ownership structure is very different. Getting loans on them is a completely different process. There's very local banks that specialize on those. So without getting too much into that detail, if you're dealing with a tenancy in common purchase or sale, reach out to me. I'm happy to discuss the mechanics of it. But that is one that we see very, very, very common in San Francisco, the city of San Francisco specifically. I just want to verify you can own, it could be you and I as individuals just on a personal level. You and I could be business partners, and it could be Mike's LLC and Alan's LLC, and we can be tenants in common. Is that correct?
Yeah. Yeah, your LLCs can be tenants in common, your individuals. Yeah.
One LLC, one individual. It's the one that has that flexibility, but it comes with other challenges, right? Because of the structure. And again, without getting into details, there's a whole push oftentimes with tenancy in common properties in San Francisco to do what's called a fast track condo conversion, which is a conversation for another day. But so tenancy in common is a very, very, very common one that we see in San Francisco. And so the last one is the trust, right? That's the one that you and I are both trying to advise our clients to hold ownership in a trust. And before we talk about the mechanics of a trust, I had a question. Can two trusts, let's say you had a trust and I had a trust, and we bought one of those two-story buildings in San Francisco, can our trusts own that property in tenancy in common?
Yes.
That sets up the ownership structure of the actual real property, and it has the mechanics and the protections of the trust set up for those individual ownerships of that building.
Exactly right. Exactly right. And so if there are joint owners on a property, really joint tenancy and community property right of survivorship are probably not the best thing to do. Certainly if you're married or you own the property with your domestic partner, you should not hold title individually. In that scenario, there should be likely a joint trust that you and your spouse or partner create, which holds the title to the property, and it says whatever it says, and we'll get into that in a little bit. Joint tenancy is a little bit different because certainly if you're married, you should not be doing joint tenancy, but oftentimes I'll see, a parent and child do a joint tenancy. And the thinking there is if an elderly parent, wants to give the property to their child and they figure, hey, they'll just add him or her to the title. And when parent dies, the child will enjoy the right of survivorship and inherit the property quite easily without probate. That is very true. However, what happens there is the child's tax basis for capital gains for the property gets all screwed up because instead of having a tax basis of the value of the property when parent died, full tax basis, the child ends up getting, half the tax basis for when they were gifted that first half, and they only get a step up on the second half. So the 50% that they were gifted when they became a joint tenant, that basis is there. So it's really just not a great way to go. And the other concern there is if, in that scenario, if child gets sued for whatever reason, either due to an accident or a business gone wrong or what have you, then the title to the property is on the hook for that child's judgment or creditors or what have you. It's an asset that they own. We don't really recommend joint tenancy or community property with right of survivorship as a permanent title fix. That if you end up holding title in those ways, that should just be a short interstitial thing, and ultimately the title should go in a trust. Now, if you're married or your domestic partner, it should likely be a joint trust. If it's the parent-child joint tenancy example, that sounds like it's parent's trust, and the child inherits through the trust. It does not sound like a trust for mom and son. That's not something you'd want to do. Tenancy in common is a bit different because when you buy as tenants in common, you are going into that hopefully with the understanding that there's no right of survivorship. Now, I have seen people who are really not paying attention at closing. I've seen husband and wife take title as tenants in common, purely in error that nobody caught. It can happen, right? It's a crazy idea, but it can happen.
Yeah.
But if you're, tenants in common, it's because you and your business partner or your friend, you guys are buying a property and you each want your own chunk, your own share of the property that you can give to your family, that you can pass on, right? There's no right of survivorship, right? If me and Mike bought a house together, an apartment building together, I would want my 50% to go to my family and he would want his 50 to go to his. So that's why there's no right of survivorship. So when you do that, that sort of brings us back to the, where we started, individual title holders, right? In that case, you want a trust to hold your share of that tenancy in common. You should never, ever have individuals on title to property. I mean, that's the short of it, right? So if you're considering, your name or joint tenancy or community property, get a trust in place and put that on title instead.
Yep.
If you're going to buy a house with somebody as tenants in common, your trust should be the tenant in common with that person. So that's really the bottom line, if you will.
So to reiterate for everyone who's watching, don't buy a house in your own name. Spend the money, set up a trust, and maybe with that, we can segue into trusts, what their basic function is, why do them, and we've talked about why doing them, but maybe we could talk about them in depth, what trusts are, how they function, and what are the benefits, and if there's any drawbacks to a trust. And then, ballpark, what would be the rough cost of setting up a trust let's say for a very simple scenario of a husband and wife or a domestic partnership, what would be the cost of setting up a trust versus, God forbid, somebody owns a property in their names and they pass away, and then their kids have to deal with, or their next of kin has to deal with probate. So what would be the cost comparison there? So feel free to start wherever you feel is best and would be most impactful.
So trusts have been around for a long time. These are structures that were used in England 100, 200 years ago. These things are, these are long-standing instruments, much longer than that even. And there was always a bit of a misconception, at least it's now a misconception, that trusts are only for the wealthy. Wealthy people need trusts. Nobody else needs to worry about it. And unfortunately, that's really not the case. Over the years, the courts have become much more busy. Things have become much more expensive. So maybe once upon a time when, maybe in the 1950s, if you had a house, maybe you didn't need a trust because your probate process would have taken a few months. But now the courts are, in my opinion, a non-starter as far as, how to settle your estate. So trusts are no longer for the wealthy. Instead, trusts are for anybody that own real estate or have any other assets which would have to go to probate unless you have a trust.
And what assets would possibly have to go to probate unless you had a trust?
It can be a bit of a case-by-case analysis because there are other ways to avoid probate. But typically, if you have real property, if you have bank accounts, if you have brokerage accounts, if you own businesses, you should strongly consider a trust. If you have minor children, you should strongly consider a trust. If you have beneficiaries, family members who have medical needs, who have drug and alcohol issues, or for whatever reason you're just concerned with them getting access to that money, you should consider a trust. So really it can include all your assets, but for most people, where they first sort of run into the idea of doing a trust is when they buy their first home.
Right.
Because all of a sudden now it's an expensive asset. You're spending so much money in this, and it is just, there's no good way to transfer that house to your heirs when your time comes without a trust. Otherwise, you're setting them up for probate. And so, when you do a trust, the other misconception, or the first misconception is, oh, it's only for the super rich. Not true. The second misconception, oh, it's really complicated to create a trust. It's such an ordeal. It's such a pain in the butt. Also not true. Now, we've, I think, done a pretty good job of setting up a way that people can do this without turning it into a massive ordeal. Now, yes, there are very important decisions to make when doing a trust. Who gets your assets? Who has decision-making power? However, we've designed a system where we can help you make those decisions, and we can get this done fairly easily, right? So it's not going to be some super crazy long, complicated process. You can get it done in a month, quicker if you'd like. And so it's no longer a huge ordeal. And the third sort of misconception is that it's super expensive to set up a trust, and also no longer the case. Depending on your situation, depending on the complexity of your goals and the complexity of your estate, the price will vary. But for most folks, you're looking at less than $5,000 for a married couple, and you're looking at less than $4,000 for a single person.
I mean, again, we're not giving any, final estimates to anyone here on this video. Everyone's situation is going to be different. But just on a high level, I think it's important to recognize that you're looking at spending about $5,000 ballpark versus your family losing about $30,000 to $40,000, maybe $50,000 worth of your entire estate when you pass away. And I think when you look at that as a cost benefit analysis from just that standpoint, if you're like, well, is this really worth it? I don't think it could be any clearer. It's absolutely 100% worth it. So I just wanted to highlight.
That's a very good point. And to sort of contrast how it would function with the trust and without, right? So, you spend less than $5,000 to set up your trust. By the way, in addition to the trust, that will include things like nomination of guardians for minor children. That will include things like durable powers of attorney for incapacity decision making. And we could get into that also, but it's not just a trust, right? It's a full estate plan that has all these various things, and it takes you a month to create, and you're all set. And, that fee is the same whether you have a, $500,000 condo or whether you have a $10 million house in Atherton. It's the same fee because frankly, it's the same process and it's the same decisions. Or you can choose to not have a trust, hold title in your names, and then the house will go through probate. It will cost a percentage of the fair market value. And, I gave an example earlier. It's for $1 million condo, $23,000. Well, that's based on the value of the property today for that condo. That condo, when, Joe dies 50 years from now, is going to be worth much more. And frankly, a lot of your clients might have properties that are worth more than that. So, if you have a $2 million home in Belmont, then you're looking at a much bigger cost to probate. You're looking at $30,000 in probate fees, and you're looking at a 2-year court process. So in our view, and I think, pretty much every estate planner in the Bay Area would agree that you want to spare your family the joy of probate, and you want to hold title in a trust and not in your name.
Absolutely. Agreed. 100%. So aside from real estate, we talked about, and correct me if I'm wrong, I think there's quite a bit of things that you could, for lack of better words, hold in a trust. Aside from real estate, from property, you can also, large sums of money on bank accounts, brokerage accounts. You mentioned, if I'm not mistaken, you can't have retirement accounts in a trust, but
it depends.
Depends.
You wouldn't necessarily have the trust own the retirement account. That's more of a case by case analysis as far as what should go in a trust versus what should not. For most people, because the conversation does change for those of us that might have a higher net worth, right? So if you find yourself in what we call an estate tax situation, so you're 25 million plus, it's a different conversation.
Yeah,
a good problem to have. I don't have that problem, and most people don't have that problem. So for most of us, really the goal here is not some super brainy tax play or anything like that. The goal here really is twofold. It's to avoid court when you pass away so that your assets can go to your loved ones without court. And we haven't touched on this yet, but it's also important. It's to avoid a conservatorship if you become incapacitated.
That was the next topic I was going to ask you about. I've seen in trusts that there is a way to also give direction if, God forbid, something happens to you, become medically incapacitated in some way. There is a way to give instructions, for lack of better words, in a trust. Is that correct? Yeah.
So the trust, for any assets which it holds, there is a transition of power if you become incapacitated. So let me back up a little bit. So we've talked about what happens if you pass away and the title's in your name. So if you become incapacitated and you have assets that are in your name and not in the trust, nobody has the authority to do anything with those assets for your benefit, right? Nobody has the authority to write checks to pay your bills. Nobody has authority to take any action for your assets, even though you are still alive, you are still perhaps living in the home, benefiting from those assets. And if you're incapacitated without any estate planning documents, your family needs to go to court. It's also actually probate court. It's the same court, except this time it's called a conservatorship. And what that means is the judge gives somebody the power to act for you. Probably worse than a probate, to be honest with you. Probates are expensive, but they do have a, beginning and end. It is a process that will, after a few years, finish. But many conservatorships last for years, for the entire length of the incapacity. People get sick for 10, 20 years, and that whole while, the estate's in conservatorship. And what that means is there's accountings to file with the court. The court has, oversight into all of this, and it's a huge time suck for your family, and it's a huge expense. So you want to avoid a conservatorship as much as you want to avoid probate. And the trust does that as well. So for any assets that are in the trust, if you're still alive but incapacitated, you appoint decision makers to deal with those assets for your benefit, subject to whatever the trust says. So whatever terms or conditions or what have you. This type of planning, living trusts are not just for real property. They can be used for a bunch of different assets. And the analysis of what assets will go into a trust versus not, that generally is a case-by-case situation. So I invite folks to give me a call. Give me 30 minutes. We can talk. I can learn really briefly about your situation, and we can develop a bit of a plan for you as far as what, if you need a trust, what should go in the trust, and things of that nature.
Well, this was super informative. Was there anything else you feel like we might have not covered that you feel is important to mention to our viewers here?
Yes, I have really not mentioned one super important fact in that these trusts that we've been talking about for a little while here, these are revocable trusts. When you get into the world of trusts, there's at the very top level 2 different types. There are irrevocable trusts, which are generally more complicated, more expensive, and a bit of a pain to deal with. And there are revocable trusts. So the trusts that we've been talking about are revocable trusts. And the beauty of revocable trusts is, as it sounds like, you can change them. You can change everything that it says. You can rip it up. You can take assets out of it. You can put assets into it. It's all very flexible. And more importantly, it does not change any tax structure of those assets. All those assets continue to be reported on your personal tax return. The trust does not have its own tax ID. It's all very, very transparent and easy, which means not only is tax easy, but getting a loan is easy. Dealing with your mortgage broker is easy. Everything's easy with a revocable trust because it's really you. It's an alter ego of you as far as your lender is concerned, as far as the taxing authorities are concerned. So that's really what we're talking about, are revocable trusts. So once you set it up, if you want to come back a year later and add a new child, add a new property, it's all very doable. The other types of trusts, the irrevocable trusts, we do assist with those as well. They're a bit more rare. They're intended for more of extraordinary circumstances, either higher net worth families that need estate tax planning, asset protection planning, or very specific goals. Most people do revocable trusts. Certainly anybody that has or wants to get a conventional loan on a property should be doing a revocable trust, because no lender will really entertain the idea of an irrevocable trust.
Protection. So there's maybe a misconception or some theory out there that a trust sets up certain layers of protection. And one thing I wanted to really touch on is there's a difference of who basically granted that real estate to the trust, right? They transferred it into that revocable trust. They're the owners of that property still. And so one thing I wanted to ask you is, let's say there's a situation where, somebody's trying to come after them for debt. Let's just keep it very general because everyone's situation is specific. Does that trust give a layer of protection or no?
No. So the beauty of a revocable trust is its simplicity. It's the fact that it uses your social security number for tax purposes, that your lender doesn't care about it, all that. It's wonderful. But because of all that, because it's transparent, it offers no protection against creditors, judgments, none of that.
Right.
An asset which is held in a living trust is just as exposed to those types of claims as an asset that is in your name. The trust, the revocable trust, what it protects against are probate and conservatorship, and against your kids inheriting the property through intestacy laws and spending all your hard-earned money within 6 months.
Yeah. Yeah. Well, but it does protect you, right? Like, let's say your kid is not on the trust as a trustee of the trust; they're just a beneficiary after your passing. It does protect you in that sense. Is that correct?
Yes, once you pass away and your beneficiaries, which is the term we use for those that will receive the trust assets, once your beneficiaries get the assets, there are ways that you can handle that distribution to them in an asset protected manner.
Yeah.
Your trust can distribute in further trust. These would be sub trusts under your trust. So there's a lot you can do. But, I found that over the years, I've done this, as I said, for more than 15 years, done thousands of trusts, helped a lot of folks. Those are all really fun ideas to explore, and I enjoy it. But really my goal, my message here is, try not to get lost in the weeds there. The first step is get your trust done, make it basic, just get a trust in place and distribute the assets. And then as life goes on, or even, the very following month, let's iterate, let's go down rabbit holes. Let's think about really creative ways to do all that. But first, get it locked down, get title into trust. And I experience this all the time. And, indecision obviously is, we all suffer from it. I totally understand. These are really hard topics. And,
Yeah.
And oftentimes that occurs with nomination of guardians for minors. That's really for those of us with minor kids. That's an area that some families get bogged down by a little bit.
Yeah. But it's better to make some decision than no decision, and then it's going to be decided in the courts, and your kids may get stripped away from all those valuable assets may get stripped away from your kids by some cousin or estranged brother or sister or something like that, or even parent.
Exactly. Set it up, do a minimum viable product, if you will. Just get the basics on paper, get it all set up, and then iterate, add to, expand over time. You'll have the chance, when we do estate planning, when we do trust for folks, we have a membership plan that they get enrolled in. That means you get free amendments, free changes. So, if you do your trust with us and 6 months later you wake up in a night sweat that you forgot about somebody, don't freak out. Give us a call. We can add to the trust and we can amend it. All part of this membership plan.
That's great. So let's maybe just recap all the key takeaways. For those of you that own a substantial amount of assets, including real estate, a lot of cash in the bank, these are probably the top two reasons why you should be really considering talking to someone like Alan and setting up that trust. And as he recommended, just start with something basic, something simple. Don't overcomplicate things. Don't start hopping on various AI platforms and reading things and getting misguided basically by all the information out there. I think it's important to just pick up the phone and call a professional like Alan and just have a quick conversation, just get an understanding of what the cost would be, and all the benefits that you would have from setting up the trust. But I think the biggest takeaway here is, for me at least, is don't ever buy the house in your name. I think that's it. There's no rhyme or reason.
That's it.
There's no benefit. I mean, unless you don't have the money to set up the trust. But then that raises the question, should you even be buying a house? Because you might be stretching yourself thin there. But short of that, I really don't see any reason whatsoever as to why someone should not set up a trust. And that's my biggest takeaway from today's conversation.
That's absolutely right. We probably could have skipped the whole portion of this chat where we went through all those, ways that you can hold title as an individual, because quite frankly, that you shouldn't do that. Title should be in a trust. That is sort of the bottom line. So yeah, if folks can remember that certainly is something they should keep in mind. And the one thing that sometimes happens, and I'm sure, Mike, you see this all the time, people are in the process of buying a home and they can't get the trust done. They don't have a trust. They can't get it set up before closing, and that's fine. Don't panic about that. After closing, you can set up your trust. We can move title into the trust. All that can be fixed. No problem. But certainly don't wait, too long. Don't wait
something happens.
A year, 2, 3, or 5, right? Yeah. Just get it done. So, you don't need to scramble before closing. And in fact, your lender might really not like that. And that might not be the best thing to do in the 2 weeks before closing. So maybe take title in your names, and then the following week or two, give me a call, and we can take care of moving title into a trust.
Awesome. And how long does it usually take to set up, generally, just kind of on the average, how long does it take to turn around a trust?
Take about a month. It can be a little quicker if folks have their decisions made. Sometimes it takes certain folks a little longer to decide on who gets what and who has what power. But if you go into it knowing the assets are going to my kids, and my kids are the decision makers, and everything's sort of pretty obvious, you could 2-3 weeks definitely.
Great. Well, Alan, thank you so much. This was, for me, very educational. Even though I deal with this on a daily basis, I learned a lot. I hope our viewers learned a lot. And if anybody would like to get in touch with Alan, we're going to leave his contact information here down below. Again, my name is Mike Sinitsky. I'm with Rise Homes, your local San Francisco Bay Area realtor. And we hope that these videos that we make are helpful for you, whether you're planning on buying or selling. And we're happy to bring guests like Alan to share insights with us. This was very helpful. Alan, thank you very much. Appreciate your time.
Thank you, Mike. Thank you, everybody.